In today's episode, I'm going to share with you my highest accuracy, highest win rate day trading strategy. This is the strategy that I'm currently trading during my small account challenge. Right now, I'm in the middle of a small account challenge using Thinkorswim, using a cash only account, and so I'll be updating you on my progress. Today is an update for day 8 and day 9. Now, for this challenge, I've had to do things a little bit differently. In my regular account, where I'm above 25,000, I can day trade as much as I want. If I want to take 1,000 day trades in one day, I can do that. And since I know with my main account, my regular strategy averaging about 68% accuracy, as long as I take enough trades each day, I should be able generally in decent markets to close each day green. But in the small account, I can't quite do that. I've got some limitations. And so I've had to modify my typical strategy based on these guardrails that the small account is putting on me. The first is that it's a cash only account. And so I can only trade with the amount of cash that I have. So for instance, with $10,000 cash in an account, you take one trade of 1,000 shares of a $10 stock, that's $10,000 position. You buy it, you sell it, and now you can't trade with that money again until it settles overnight. So you could trade again tomorrow. So effectively, if you're using all of your buying power on one trade, well, you can only take one trade a day. But here's the problem with that. I'll jump onto the whiteboard. Let's say day one, you start with $1,000 in your account, as many people might for a small account challenge. And let's say for this small account challenge, you're being pretty aggressive. You're wanting to try to grow the account as quickly as possible. Well, let's just say you have the misfortune of losing $250 on that first day. You take a couple of bad trades and you start to spiral, and it's just an absolute disaster. The account's down 25%, which means your current balance is $750. Uh-oh, not good. Now, your first goal is just trying to get your account back to 1,000, but growing your account by 25% won't do it. Now you've got to grow this $750 account by 33% in order to get back to whole. And so very quickly, you get the cards stacked against you when you're in a small account. And so one of the things that I've always known is that when I do small account challenges, I have to essentially be very, very picky about what I'm willing to trade. There's actually a great book here. I'll show it to you. This is a book called Thinking in Bets by Annie Duke. And in this book, she talks about, she's a professional poker player. She talks about her brother teaching her to play poker. And he said, these are the hands you'll play. And it was only a couple of hands. These are the only hands you'll play. And anything else, you fold, you don't play it, you know, whatever. And I thought that was really interesting because she said, wait a second, I'm seeing all these other players at the table that are playing hands that aren't on your sort of pre-approved list. What's the deal with that? And he said, yeah, well, they've got a lot more experience than you. I want you to only trade the hands that have the highest percentage of success because as a beginner, you need those wins. Those wins build confidence. All right, so I'm going to apply that same lesson to my small account. For the small account strategy, I'm not going to take high-risk trades. I'm not going to do, for instance, a high-risk dip and rip on halt resumption or a red to green move, or maybe perhaps trading an IPO, the second at IPOs. Those are setups that I may be willing to take in my larger account where I can take more risk. And if I have one loser, well, I can take 10, 15 more trades that day. And with 68, 70% accuracy, I'll be able to recover from it. But with a small account, I can't do that. With the small account, every single trade I take has to matter. It has to be the right setup. So let me walk you through my approach each day. We're going to start number one with stock selection. So for my stock selection process, I am being a lot pickier during the small account challenge. So just for instance, yesterday, when I first sat down, we had this stock, ONCO, that hit the scanners. Now, ONCO, I initially pulled it up, I looked at the stock, and my first reaction was, the float is a little high at 23 million shares. That was my first gut instinct. I said, that float's a little high. Now, for those of you guys that are familiar with my 5 pillars of stock selection, I have 5 basic criteria that every stock needs to meet in order for me to be willing to trade it. So I'll just break these down really quickly so we're all on the same page. So the 5 pillars of stock selection. Number 1 is price. Number 2 is percentage change, percentage up today. Number 3 is relative volume. Number 4 is news. And number 5 is float. Now, I would honestly say out of all of these criteria, which ones are absolute deal breakers? Well, if the stock is $200 a share, I cannot afford it in the small account. So there's no question that these are deal breakers. So, and I could actually sort of separate these two between the small account challenge criteria on this side and then my regular account on this side. So in my regular account price, really anything from generally 50 cents a share at a low to $20 is preferred. But I don't mind trading something that's more expensive. I mean, look, when GameStop went up to $200, $300, $400 a share, I was trading it in the regular account if I was happy to. Wouldn't have been able to afford it in the small account. But in my regular account, no problem. So price, I've got a little bit of a wider filter there, a wider net. But in the small account, really can't, I honestly don't think I would trade anything over 10. So 10 is the max price. It just doesn't make sense because I wouldn't be able to buy enough shares. And if I'm really going to be honest, I could almost say like $8 max, but right now that it's day 8, day 9, I have a little bit more buying power, so I might, if I saw something at $8, take a trade. So I would say $9 max. We'll cut it in the middle. So right now, small account challenge, 5 pillars of stock selection, can't be above $9 a share. And minimum price, well, I wouldn't mind taking a trade on something 25 or 30 cents a share, so I won't put a minimum on there because it's a small account challenge. So number 2, percentage change on the day. So generally, this should be in, it doesn't really matter, but $9 max. So for percentage change on the day here, I really don't want to trade something that's not up at least 50%. In the regular account, I would say 30% minimum, 10% absolute minimum, but 30% would be tolerable. So I'll say 10% because that's sort of the minimum. And this is really a sort of a stark contrast here. And what I'm saying is I need something up 5 times more at a minimum for me to consider it in the small account challenge. Now, some people would say, Russ, that's crazy. Why would you buy something that's that much higher at a minimum for your small account challenge? Don't you want to buy low and sell high? Well, remember, I am a momentum trader. So as a momentum trader, I'm looking for the stocks that are moving the most. And what I know beyond a shadow of a doubt is that when a stock is up 50% and it's one of the top leading percentage gainers in the entire market, there's a lot of eyes on that stock. And what that means is that that stock has a much higher likelihood of going up another 10, 15, 20, 30% than a stock that's up only 10%, going up another 10, 20, 30%. So, for a stock that's up 10% to go to 40%, it's got to go up significantly more. For a stock that's up 50% to go up another 20%, that's not as big of a move, relatively speaking. So it's actually going to be easier for me to capture profits on something that's already got that big rate of change, especially since I'm going to be a real sniper about getting in quickly and getting out quickly. That's going to tie in to the entry indicators and the exit indicators, which I'll talk about in a moment. So number 2, percentage change. It's got to be at least 50% on the day for the small account challenge. Relative volume. To be honest, I would prefer relative volume of 100 or more. And I'm just being honest. I would prefer that. For the small account or for the main account, I do relative volume of 5. But relative volume of 100 or more, that tells me that this is a stock that really has the potential to do something incredible. And I'm actually going to go onto the back here and I'm going to share with you a couple of sort of bonus criteria for stock selection. So bonus. So one is super high relative volume, which is the result of yesterday's volume being under 100K. So if yesterday's volume is less than $100,000 and then today the stock trades on 20 million shares of volume, that's a massive imbalance. Like that is a huge spike. And big spikes like that are important. So look at this. So this stock traded 2.5 million shares the previous session and then traded 34 million. But the session before that, it traded 227,000 shares. So the imbalance was big, but the reason this shows 2.5 million in the previous session is because the news came out after hours. So that after hours is when the move began. So basically this had zero volume here all day long, 100,000, 200,000 shares. And then boom, right at the close, right after hours at 4 p.m., it had over 1 million shares of volume come in within 10 minutes. And then it just continues to trend higher until it's got 2.5 million shares of volume. Now, as you can imagine, there was a news catalyst that came out right at 4 p.m. So 4 p.m. news. Now, for this, this is actually an interesting one. In the main account, news is preferred, but it's not required. The reason it's not required is because sometimes we'll see stocks that make huge moves, but they don't have a catalyst. And the fact that they just are at a certain point up 75, 80% becomes, in a way, its own catalyst. And that can be a little tricky. And unfortunately, while those stocks can give big moves, a lot of times they don't hold those moves. So they become kind of exaggerated in price. There's a lot of enthusiasm. People are buying it up, but then reality sets in and they dump and they sell off hard. So for the small account challenge, I'm more inclined to say required. That news is not just preferred, it's required, because this is what actually is justifying why the price is going up. Now, when it comes to float, in my main account, generally I say, 20 million shares is approximately my cutoff. Now, in the main account, I was happy to trade ONCO. The float's a little higher, but there's also a reverse split, which sort of complicated it a little bit. So ONCO, I did trade that. I was okay with that. It's a little bit higher. In the small account, I really feel like right now, sub 5 million share float is pretty much required. And in fact, less is better, exponentially better. So of all of these pillars right here, the one that has the potential to knock out any trade is if I pull up a stock in the float to 180 million shares, I'm not even going to pull up the chart. I'm not even going to look at it. I just know that that stock is going to be thickly traded. It's going to be dominated by high frequency trading algorithms. Now we could talk about why those stocks are so popular among those high frequency trading algorithms in a moment. But the reality is there's a pocket in the market where retail traders find success. And then there's the rest of the market that's dominated by institutional traders, hedge funds, and high frequency trading algorithms. And when you trade in that area of the market, it's like playing chess against the computer. You're going to lose every single time. I'll expand on it just a little bit while we're on the topic. The reason this happens is because these high frequency trading algorithms have an edge against you. They subscribe to the feed of all market data, and they can actually see your order coming into the market before it executes. So if they see a 10,000 share order come into the market and they had a sell order, they can pull their sell order back and put it higher so you fill at a higher price. So they realize, wait, there's someone coming to buy. I'm not going to sell at this price. I'm going to sell at a higher price. And dynamically, instantaneously, they can move their order higher so you get filled at a higher price. And then when you turn around to sell that order, they see your sell order come in and they had a buy order there on the bid and they say, oh, let's move that down. Let's get this person more slippage. So that algorithm actually is essentially creating the slippage that you get on your trades. Now, on a small cap stock, these high frequency trading algorithms don't usually even trade. They don't make the market on these stocks by being on both the bid and the offer, because these stocks have the potential to go up 50% or 100% in one day. And that carries way too much risk, too much downside risk. So in fact, the stocks that these institutional traders love are the super liquid stocks that trade in relatively narrow ranges. Like what? Like Bank of America, like Sirius Satellite Radio. NVIDIA, Tesla, those are more competitive by even among institutional traders because they are more volatile. But so if they trade them well, they can do really well, but they also carry more risk. So they look for stocks with lower beta to the S&P 500. So when the S&P 500 moves up a point, these stocks move up less than that. So essentially they're very range bound, and that's where there's a lot of opportunity. So when we're trading small cap stocks like ONCO that are going up 50%, 75%, 100% on the day, these are not the type of stocks that institutional traders, like the big traders, JP Morgan, Goldman Sachs, whatever, that they're trading, or that other hedge funds or quant funds are trading, because the risk outweighs the reward. Now, I think that is a good segue into a conversation about risk. I'm trading in a small account and I'm day trading in it, which means certainly I'm taking risk. And I'll say, as always, that my results are not typical because I've been doing this for a very long time. So I've got a lot of experience and training coming into funding this small account. I always like to do it as a challenge to see, what I can do and to test myself, but I just like to put that out there just to be transparent. Now, with this small account challenge, I have to trade stocks that are moving. I'm not going to grow the account buying large caps. I'm not going to grow the account buying something at $5 and selling it at $5. I crave volatility. But at the same time, whenever I take a trade, I have to be asking myself, what am I risking? Because if I jump into a trade and all of a sudden it dumps and I lose $2,000, that's going to kill my progress, right? Just like I said in the beginning, you take a 25% loss, now you need to make 33% to get back to flat. You take a 50% loss, you now need to grow your account 100%, double it to get back to flat. And that becomes unachievable. And that's one of the reasons that trading is so hard with a small account, because suddenly you start to fall into the negative, and now it gets harder and harder and harder to get back to whole. And as the account gets smaller, you have less and less buying power, which means you can't buy as much, and you feel like you need home runs, and then you could start to go into this downward spiral and you're circling the drain, and then boom, your account's gone. And I've seen that happen to so many traders. And so when I do these challenges, I try to lead by example and show you that this is the right way to approach trading in a small account. Okay, so now that we've got a good solid understanding of our 5 pillars of stock selection, the float, no doubt, is the one that we can't live without. The float has to be under 20 million shares. It is preferred to be under 5 million shares. News is required. Relative volume ratio should be super high. Percentage change today, 50% at least, and $9 max price. So this is all for the small account challenge. So when I'm sitting down each morning and I'm pulling up my scanners, pretty much the first thing I check is float. I'm looking at the percentage change. How much are these up? So these are all up over 50%. So these are all fine from percentage change. But float, 71 million shares, 23 million shares, 23 million shares, 39 million, 45. So in fact, the only ones in here that are worth considering would be JFU and CNEY. Now, what I can tell you about both of these is that CNEY, we traded a couple weeks ago, and it was really kind of nasty. This thing popped up and dropped all the way down. It did not hold its level at all. And so I really didn't trust it. Sometimes there'll be a stock where you look back at its historical chart and you realize, ooh, this isn't something that's trustworthy. Yes, it makes a move, it's grinding, but then it gave the whole thing back. So that requires a bit of an ability to check the daily chart, zoom back, and say, what has this thing done in the last couple weeks, right? So if you were trading this just like this and you didn't look back, you would be sort of blind to the fact that this thing just like 2 weeks ago went up like 300% and then gave it all back, right? That's a little shady. Now, if it had gone up 300% and held that level, that'd be different. And in this area right here, we sort of had the same concern. On that day it was popping up, it was like, well, we had this day right here and we had this day back here. So this stock kind of has a theme of popping up and selling off. That creates a little bit more risk. So I said on CNEY, I can't afford that risk. It's not worth it. Now JFU, this one was on the scans, but not till later in the day. So this one didn't fit within the time frame of my strategy. So this is the strategy that I'm currently trading is a 3-hour strategy, which means I sit down at 7 a.m. and I am done by 10 a.m. That is my 3-hour window. And if I don't find an opportunity within that window, I'm not going to take any trades. The reason that I put that guardrail and restriction on is, sort of just like this. That's the window where I have the highest degree of success. So while it's true that in my main account, I may feel comfortable trading at 11 a.m. or 2 p.m. or 3 p.m. for power hour, for the small account, those are times of the day where I have a lower win rate and I can't afford to take the risk. If I take an unnecessary loss, it's going to be a problem. So I'm sort of zooming in to the time of day that I've got the highest percentage of success, and that is from 7 a.m. to 10 a.m. So I have a hard stop. If I haven't taken a trade in the small account by 10 a.m., I will not take any trades that day. It's as simple as that. So JFU wasn't even on the scans yesterday morning. Now, ONCO, This one, when I first pulled it up, I observed that, okay, this is a stock that made a move after hours. And one of my rules is that in terms of setups, I have a very specific setup that I want to be trading. So let me share with you what that is. So entry indicators. All right, so the setup, and we'll just call it the setup. This is the setup that I want to trade. All right, so for me, for this strategy, for this small account challenge, because I need the highest win rate possible, the only time that I want to be trading is on the front side of a move. So what is the front side of the move? The front side of the move is when the stock first comes out with breaking news. So if we back this up here, we go back to right here, this is the only spot where I would have been willing to trade it. Now, as it turned out, this was at 4 p.m. on this stock, all right? But this is right here, the only window where I'd want to trade it. And where would I have bought this? So this stock initially has news that comes out right here. It's a 13D filing, which is a 13D filing is a form that an investor can file with the SEC. And when they file that form, where is it here? 13D. They file that form, and this tells you when an investor is taking a very large position. So if they're buying a large position, then that creates the sentiment that, wow, someone really, really, really likes this stock. That's very interesting. They like it so much that they're buying like 30% of the shares that are outstanding. So that news comes out, and immediately the stock starts spiking up. All right. So now, does this meet all of our criteria? Well, the one issue here is the float, but this stock just did a 40-to-1 reverse split, and the float hasn't yet been updated. So that means the actual float on this stock is about 500,000 shares. It's a 500,000 share float. So now, what does this meet all of our criteria? Price is at $4 a share. Percentage change immediately was up like 40%. So 50%, yeah, I think so. Relative volume, we'll check it. News, got it. Float, got it. So it meets all of these criteria for being the right type of stock to trade. But just because it's the right type of stock to trade doesn't guarantee that it's going to give me the setup or that I'll be here watching it when the setup forms. This gave us a setup. I just wasn't here because it was at 4 p.m. It was after hours, which is unfortunate, but you know, that's the reality. Now, I suppose if I had a track record of trading until 4 p.m. with a high degree of success, I could sit here all day long and just continue to look for opportunities to trade the small account. But since I know really beyond a shadow of a doubt that my success is much higher trading during, from 7 a.m. to about 10 a.m., I've put that restriction for this challenge. And that was the right move. I could show you my metrics that support that in a moment. Okay, so the stock squeezes up 1, 2, 3, 4 candles straight up. Now, when a stock is squeezing straight up like that in response to breaking news, how do you know that's even happening? Well, the stock is going to be hitting our high of day momentum scanner right here. So boom, boom, boom. This scanner is like radar. It is searching the market in real time for stocks that are squeezing up and that meet the 5 pillars of stock selection. Now, for my scanners, I actually set the filters a little wider than the 5 pillars. And the reason I do that is because if there's a stock like a GameStop or something like that, and it's making the rate of change and it has the relative volume, then maybe the float being a little higher, you know, I'll take a look at it if it's really exceptional. So although this is pretty much a deal breaker, there are some rare instances where it's worth being aware of something that's a little higher. So for that reason, some of these filters are set a little bit wider, cast a wider net, and then I manually sort of pick out the stocks that I don't like. I say, I don't like that, I don't like that, I don't like that. Ooh, I do like that one. So ONCO starts popping up, meets all of our criteria for stock selection, and as it's squeezing up right here, I'm looking for my first entry. So now I'm going to pull, I'm going to move this over for you right here. So this is chapter 8. Technical long setup 1 from my full-length day trading strategies and scaling curriculum, which is available for Warrior Pro members. And by the way, for those of you guys who are tuning in to this episode on YouTube, I will put a link in the description for a selection of PDFs that you guys can download. The PDFs will include my small account strategy, my micro pullback, and my stock selection PDF. These are resources that you can download, you can print them out, you can save them on your computer, print them out, and you can use them in your own trading starting today. I encourage you to practice the strategies that you're learning from me in a simulated environment. Prove that you can meet the metrics of success, and then once you can, only at that point, transition to real money. So again, there's a link pinned to the top of the comments, and it's linked in the top of the description, so you can download all those PDFs. All right, so I'm going to go full screen here on this. So and I'll give you sort of the sneak preview of this section that I teach to Warrior Pro members. So the first and second pullback is my favorite place to buy these stocks. So again, kind of going back to this concept of these are the highest win rate setups that I currently trade. And so what we're looking for here is a stock that's made this big move up and then for that first pullback. Now, the first candle to make a new high is the apex point of the bull flag or the flat top pattern. Now, sometimes I will enter a little early to anticipate the breakout. And I'm actually going to show you a live trading archive where I did exactly that. But during the small account challenge, I can't do that. I can't get in early to anticipate, because if I get in early, I'm getting in without confirmation. If I don't have confirmation, I'm going to look back at the trade if it was a loser and think, I really shouldn't have traded it. So although you pay a higher price for confirmation, because you wait for the stock to get a little higher and to break that apex of the first candle making a new high, in exchange, you get higher accuracy because you're trading with confirmation. So if I'm entering early, typically what triggers that entry is either a break through a psychological level just below the apex point, like a $0.50 or a whole dollar, or seeing a surge of buying on the level 2 and in the time and sales, which I'll show you in the live trading archive. I would always prefer to have an early entry because it offsets the risk of a bull trap or a false breakout. And while that is true in my main account, in my small account, I need highest win rate setups. That's going to take priority. So almost immediately upon entering, I want to see the price moving up. Now, let me show you what this looks like so you can visualize it a little bit better, and then I can go back to describing it in a bit more detail. So this is an example of the setup that I like to trade. You've got 1, 2, 3, 4 green candles in a row. You've got 2 candles of pullback, and then that first candle making a new high right there, that's your entry point. Sometimes I think of these at momentum trading as we're trading these waves. We get a wave up and a pullback, and then another wave up and then a pullback, another wave up and then a pullback. And these really strong stocks are kind of like that. So rather than buying at the top of a wave, wait for that pullback. And then the goal is to try to get in as soon as it's sort of starting the next wave higher. And the best way to visualize that is either that we're holding support down here at a level, maybe we double bottom and we don't break it, we just keep holding. So it's like, okay, there's visual support there. Or we actually start making a new high and then we're starting to stair step back up. Now, the thing to be, of course, cautious of is what if you have a wave and it pulls back and then it stops here, right? Stops here. Now we're running into resistance and we might be falling. Now we're going into sort of the waves going back down. So the tide kind of rolls in and then the tide can kind of roll back out. And that's very common in trading. These are the waves that we see of price action. And these are waves of sentiment, of actual people buying this stock because they like the setup. So if we animate this, we see a stock that hits our scanner and beep, 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 we're getting the audio alert, just like radar. It's telling us there's something on the horizon here that's we got to pay attention to. Stock's moving higher. Now, are you going to just jump in right here? Technically, when you have a topping tail like that, you've got the stock that's squeezed up and pulled back down. This is, of course, a candlestick chart. And if you want to watch some of my episodes about how to read candlestick charts, there's some great episodes on YouTube that you could check out about that I've taught. So you get a nice pop up there, then you get a little pullback, and that's actually the first wave. So a fast, high-speed trader using 10-second charts or tick charts or using level 2 might have actually taken an entry right here on this pullback. But most beginner traders are going to have to wait for a more established pullback. So now you get the pullback here. First red candle. All right, it's starting to pull back. It pulls back a little bit more. And then down here, we're starting to base out, right? We've got a double bottom kind of right at this level, which is fine. And again, a more aggressive trader trading in an account where they could take as many trades as they want might buy this double bottom right down here with a stop max loss just below that level. The correct place to exit this trade is if it goes lower right here. So that is your correct max loss. The only problem is that if you got in right down here and then it drops, you'll look back and think there was never confirmation. What does confirmation look like? Confirmation looks like the first candle making a new high, which is right here. When this candle makes a new high, that is confirming the wave is moving back up. Now, this is a particularly big candle. Sometimes that first candle make a new high goes like halfway up, and then the next candle continues to resolve all the way through the high of day. Now, I'll show you some examples of this. Let me show you a couple charts, and then I'll show you the live trading example. So here you've got 2, 3, 4, 5 green candles in a row. And what's happening here is this is a stock that has breaking news. So news has just come out. The stock is now squeezing up and hitting our scanners. So some people think, wow, if I could just be the first one to find breaking news, I would make so much money. And I'm actually going to caution you on that and tell you that's not how it works. Because let's just say, for instance, that the news on this stock is they just got they just sold some pharmaceutical patent for $30 million. All right. Now, we've got breaking news. That's great. You get that news first and you think that's wonderful news and you buy the stock, and then the stock tanks. And you're like, I don't get why it's tanking. And then you look and you realize that a week ago they had news that they were in negotiation to sign a $300 million patent, distribution agreement. So they finally sign it. It's for only $30 million. That's actually bad news. It sounds like good news, but with context, you realize it's bad news. So when you're the first one to get news, it's almost untradeable without seeing market reaction. So you need to see how other people are reacting. It's kind of a funny thing, but it's like, is this good news or bad news? I can't tell until I see other people move, unless you know all of the context of that company. And there may be some rare instances where there's breaking news, like Warren Buffett just bought a stake, and you're like, okay, this is probably good news. I'm just gonna take the risk and punch it. But to be honest, I've always felt that type of trading is a little bit of a gamble, and it's much safer to wait for the market to react and then to jump on that next wave of momentum. So that first push higher is generally created just by some of those early aggressive traders. Some of them might be gambling a little bit, but if it works, it works. And then the more calculated trades come in after we have that first pullback. So first pullback, and we generally prefer that there's lighter volume on the pullback, because that tells us that although there's selling, it's not like people are dumping the stock and it's tanking. So light volume pullback, and then first candle makes a new high right here, and we surge back up through the highs. Boom. So that entry right there is where I'm a buyer. That's the exact entry point. So for me, I need to see first the squeeze up. A couple of nice candles pulling away, a little pullback right here, a bottoming tail, first candle makes a new high. I'm buying right here. My max loss is the bottom of that bottoming tail. Target is high a day, and this stock squeezes all the way through high a day of 580, all the way up to 620, 640, 660, 680, to 720, 740. Holy moly. That's an incredible breakout. So realistically on this, you're risking like 20 cents a share and you get almost $2 a share. That's a fantastic profit to loss ratio. Now, it's also noteworthy that at the beginning of the move like this, the MACD is open. So this is a stock that had news early and was kind of grinding, sort of pushing higher. And the MACD pretty much stayed open this whole time. And then finally here, it started to really pull away with some speed at around 8:30. So that's where it went from 5 to 560. And that's where it kind of got exciting. This area here where it was grinding, it wasn't up enough on the day to get people interested. It wasn't up 50% on the day. It didn't have that rate of change. But finally, boom, we get a high volume squeeze, and now it's game time. That's what I really like to see. This is another one. Boom, high volume comes in right there, pulls back. First pullback gets bought up. Second pullback gets bought up, and this goes all the way from a low of 220 to a high of 440. It's a 100% move. That's fantastic. Higher volume buying, light volume selling, higher volume buying, light volume selling, and then a ton of buying comes in at the open right here as it surges higher. Just a beautiful move. Now this right here, what do you think about this? See, I would look at this and I would say, well, there's a problem. The problem is the pop-up was on light volume and the selling was on heavy volume. So as soon as this stock popped up, people were eager to start selling. And it seems strange because the company's headline was they announced a partnership with Volkswagen. That sounds like a great headline. Anytime a small cap company with a 30 million share float is partnering with a big company like Volkswagen, you think that's good news. But I don't know. People were eager to sell. So the fact is, was there an entry indicator on this chart? Was there a spot where you should have bought? No. Now, if you were someone who's trying to anticipate, it's possible you would have bought down here, bottoming tail, and then think, all right, first candle makes a new high, back up. But there was no proper confirmation. We didn't have a first candle that made a new high. We had a small wave up, and then we just went down. And it's also noteworthy that the float's 34 million shares, so it's a little bit higher. Here's another example. Light volume pop on news right here. Oops. Light volume pop on news right here, and then high volume selling. So look at all that selling. It's just coming back down. So that's not trustworthy. It's not something you can trade. JDZG, another one here. Decent volume on the buying, but the selling is even higher. So there's more selling than buying. That indicates weakness. And this, I'll say, is one of the benefits of being part of a trading community, because there's a lot of things in real time that you're trying to analyze to make a decision of whether or not this is a trade worth taking. What's the volume profile? What's the sentiment? Is there more buying? Is there more selling? Are there topping tails? What are topping tails signifying? Sellers are pushing it down. It's popping up, but sellers are pushing it down. Bottoming tails are bullish, topping tails are weak, right? That's why we kind of sometimes draw out like little devil horns like that. So it's a bad sign. You've got that tweezer top. So being part of a trading community means you're around other traders who have eyes on the market and who have more experience than you and are able to call out and share with you, wait a second, this is a problem. High volume selling, or big spreads, or big seller on the level 2, or MACD is negative. And all of that kind of, combines to you saying, wait a second, this helps me better digest and understand what's happening here. I think becoming a trader really requires immersing yourself in a community of other people who speak the same language, because learning to trade is kind of like learning a new language. It is the language of the financial markets. It's a language that all active traders and certainly successful traders speak very well, fluently. They can read it and understand it. And when I'm looking at charts like this, I see buy and sell signals. You may not see them yet because you haven't quite learned the language, but they're right there. So this is a live trading archive to get you oriented. This is not in my small account. This is just a good example of the setup that I like, but I'm going to take 2 trades here. The first trade I'm going to get in to anticipate the first candle making a new high. So if we look at our chart here, I'll pause this for a second. We've got this move up, this pullback here, then this move higher, 1, 2, 3, 4 candles in a row, and I bought right down here. Now the first candle to make a new high hasn't happened yet, but the MACD is open. That's the moving average convergence divergence indicator. And that for me is a very important indicator. I want to trade the front side of the move. So if we go back to the trade on ONCO, the front side of the move is from when news comes out until we have our first MACD crossover. That right there is the front side of the move. Now, sometimes it'll pull back and it will go higher, but this is the first leg. And the first leg on the front side is usually where I do the best. So in this case, we had high volume buying, light volume selling, which means that right there was an opportunity to buy the dip, right? That was the first candle to make a new high, and it bounced up to 460. Now, 460 is not bad. That's a winner. As it stalls out here, I would have gotten out of it. It drops back down, not good. It comes back up, and then it breaks through the high, which means this turned from a first candle to make a new high into an ABCD pattern. I like ABCD patterns, and it is it's a pattern that I do trade and that I teach in the classes, but it's not a pattern that I would prefer for the small account challenge because I have a lower success rate on it. Okay, so in this case here, I'm looking for that first candle to make a new high, and I got in a little early at 751. So I bought at 751, but I don't yet have confirmation. Now, the reason I got in was because I saw on the 10-second chart a bottoming tail, and I thought that looked good. But after I get in, it's sort of just hesitating here. 756, 759, 62, 69. Okay, this is working. Maybe not quite. 60. It's like it's not quite. And then there's some selling. And when I saw the selling go through there on the tape, the selling was my exit indicator. So this is a really nice gauge here of sentiment. This is the time and sales window. This is the expanded time and sales window, but this is the condensed one. And the time and sales is showing you every single order that's going through the market. So when I saw this burst of selling right here, I said, you know what? I'm just going to get out of this thing. What that told me was there's other people who don't like it right now. They're selling it. So I don't like it either. So I pay really close attention to what other people like. And essentially, that is momentum trading. If other people like the stock, then I'm buying the first pullback, and I'm expecting to see green on the tape because people like it. And then if people stop liking it, I'm going to see red on the tape, and that means I should get out. So it's kind of funny because there's an element of trading that is sort of following others. Sort of, what are other people liking? Other people like the stock. It's up 100%. Okay, then I like it too. I'll consider it too. People don't like the stock anymore. Well, I don't like it anymore either. And there are times where you might have a diverging opinion from the crowd, but generally I've found it's a lot easier to trade with the trend than to try to trade against the trend. So I'm a trend trader, a momentum trader. Okay, so now in this particular example here, I got out, it dips down, and then I'm going to get back in. So it comes back down, and what ends up happening here is we double bottom off of about 45. And as we come back up here, we're going to watch here. This candle's now closed. So see how I'm moving in this window right here? You might notice that I'm kind of adjusting the chart. I do this a lot. I sort of want to just adjust it just to get the scale better, just so I can see the high and the low of these candles. So I'm now going to move my mouse. I adjust this one. I check that candle. I make the 1 minute a little bit bigger, right? And I'm like, okay, is this something I like? So I add back there, and that was a slightly early entry. The correct entry is right here. Right here is the correct entry because that is officially your first candle making a new high. So the first trade I took was too early. The second trade was also early. This right here is confirmation. So with an entry at about 85, this is the correct entry. And now watch what happens when we get confirmation. It goes to 788, 794, $8, $8 on the ask, which means now we're coming up to just about our high of day. We've got two sellers on the ask right now at 8. So there's, a couple people selling. They want to take profit at the whole dollar. And I want to see if it can break through that resistance. Now, in this case, it goes immediately through 8. And as it pops through the whole dollar of 8, as soon as it pops up, I take half off the table. So now I'm selling half at 823 and it's gone. I sell another half at 823, 826, and that's gone too. So I'm taking some profit off the table. One of the things that you learn in trading is that most stocks trade with a great deal of respect to half dollars and whole dollars. And so the trades that I just took were at 750 and 8. Well, right around that level. So I'll just sort of draw this out for you. Okay. So what happens is typically when a stock first pops up, let's say this is 750, this is 8, this is 850. When a stock first pops up, it's got breaking news down here, and immediately it spikes up. Usually the first spot where we have resistance is at a half dollar or a whole dollar, and this is people who are thinking, I just am going to take some profit on this. 750 sounds great. So they take some profit at 750. And then what happens is we tap that level, we pull back for a second, and that creates our first pullback. And then we punch through 750. So now we break through that level. What often happens after that is we come back down and we retest. Can we hold 750? This was previously resistance. Can it become support? In other words, are there people that are putting buy orders down here to buy and are creating support right at 750? So usually what happens is as we come up to these levels, there's a lot of orders clustered right around these levels. And there's not a lot of orders in between. And then we start to get a lot of orders and then not a lot of orders, and then a lot of orders and then not a lot of orders, and then a lot of orders and then not a lot of orders. So what that means is that where are the areas where you think a stock would move faster? In between the areas where there's lots of orders. So once we broke over 750 and held 750, we went straight to 8. Now in this particular case, we actually broke through 8, which is kind of unusual. We squeezed through that level and immediately I took profit because what I knew was going to happen is we would come back down and test 8 as support. And if it holds support, then there's another opportunity for a trade moving up to where? 850. And then again, it's possible that this could be really strong. It just blows through 850, maybe even goes up to 9. But that's when we're getting parabolic, and that's not as common. It's awesome when it happens, but it doesn't happen on every single trade, so you can't expect it to happen. So now I've gotten in this thing. Let's back this up. This is looking pretty much, MACD is open, right? Our MACD is open. We've got a nice volume profile, high volume buying, low volume selling. Now volume coming back in here on this candle. And if we back this up just a second here, we'll go back to the confirmation. So the confirmation was right around the high of the previous candle, which is right around 75. So I look at the high of this red candle here, and the way to know the price to the penny is to actually put your mouse over it, and then this will tell you the high of that particular candle. By default, it's showing you the high of the current candle, but if you put your mouse over that candle, it tells you the high and the low of it. So the high was probably about 75, which means the proper entry was around 75. So if you got in that with 2,500 shares at 75, your first target is 8. Now your max loss on this is the low of this pullback, which is around 740. It's a little bit of a bigger stop, which is not ideal. That's part of the reason the early entry helped. So now we come up to 8, and we see a little bit of resistance as we come up to 8, right? There's 2 sellers, 3 sellers, and then immediately it breaks through 8. So I take some profit off the table as we break through the whole dollar. Now I expect we're going to come back and retest 8. So watch what happens. Now we've got 816 on the bid. I take a little more off. Now, it's always possible that it could have gone straight to 835, 840, and gone to 850, but it's more common that they come back and retest. And now it's back down there at 8, retesting that whole dollar. But as it retests the whole dollar of 8, it seems that there's support there. So now where we previously had resistance, we have support. So again, we're trading right around these levels. And this is really what I'm doing on every single one of these trades. I'm trading around these big levels. So if we go back to this slide right here, so immediately upon entry, I want to see the price is moving up. If the price moves down immediately, my timing is wrong. If I have a starter position, I may hold with a stop at the low of the pattern and look to add near the support level, or near, which is closer to my stop, or add if the price returns back to the breakout. However, when I go red on a trade almost immediately, I often change my perspective to just getting out break even if I can, either through adding near support and selling when it comes back up, sort of comes back out to that level, or simply trying to exit at the price that I entered. But this is the type of trade that when it works well, it'll work almost instantly, like that quick squeeze from 750 up to 8. And the early entry allows me to start to accumulate a position as we see volume coming in. But that's really only something that I'm going to be able to do in my main account. In my small account, for the most part, I'm doing one entry and one exit. And so for that reason, when I saw ONCO come up on the scanner yesterday, I traded it in my main account. But in my small account, what do you think I did? Well, I've probably already told you, but I didn't trade it. And the reason I didn't trade it was because I looked at it and I said, this isn't the front side of the move. This back here was the spot to trade it. That right there. That was where we got the cleanest move. Now, right here, did you get a nice pop? We did. And I traded it in my main account and it went up a bit more than I thought it would. And so in hindsight, could I have bought this first pullback? And the answer is yes, I could have. And it would have been a winner. Or could I have bought this pullback? And the answer is yes, although that's not as clean because it's sort of that ABCD pattern. And the problem with an ABCD pattern is that it requires an initial failure to work. So the ABCD pattern, and this is chapter 2, or long setup 8, chapter part 2. It requires that failure to work. I mean, this slide deck is 1,700 slides long, so I'm really sharing with you not the bulk of my strategies, but just this one that I think has the highest degree of success and that is great for trading in a small account. So yes, in hindsight, I could have traded this one and it would have worked, but I generally prefer to trade on the day the news comes out, and second day continuation can be a little choppier. This was also below its highs from the previous trading session, so I just wasn't sure. Anyways, I didn't mind taking the risk in my main account. I locked up profit on it. I had a green day, but in my small account, I said, I just don't think I could take the risk. Okay, so let's say you're taking one trade a day. You're focusing on one trade per day. You're doing this small account challenge, and naturally you're focusing on A+ quality stocks and A quality setups, trading those first pullbacks, right? So how many possible trades would you even get per day with this quality filter? I would say realistically, for me, this is going to be in the range of 3 to 5 trades. That's probably the most that I would get. And at the rate of 1 trade a day, I just have to choose essentially the first one I see that looks really high quality and that I like. Now, what sometimes happens is I'll see a setup and the stock looks great, but I hesitate. I'm like, oh, I can only get 1 trade. I don't, there's something about it that causes me to hesitate. I'm in a position where all of my years of trading have given me educated intuition. And so I usually try to trust that intuition that there's something that's causing me to like hesitate. It's probably the right move to wait, especially when the stakes are higher and I'm doing a small account challenge. But let's say, for instance, the goal of this small account challenge is to do 1 trade a day until the account has grown over $25,000. Now, if we look at my my progress right here, let's see, we've got right now 9 consecutive green days. So the account is growing. I'm definitely making progress. I've still got a ways to go, but look, I'm in good shape. This is exactly what I want to see. And for the most part, it's 1 trade a day unless I have enough buying power to take 2 trades, which is possible if I take 1 trade and I only get a partial fill on my order or something like that. But let's say we do this challenge. I get my account up to $25,000. At that point, I can then switch to a margin account and trade as much as I want. But I would still limit myself. I would still limit myself to trading only these highest quality setups, which means I'm probably only taking 3 to 5 trades a day. Something that's interesting is that right now, let's say I, have some nice trades and then I take a couple big losses. I know without a doubt that there are 30, 40, 50, 100 trades in my near future. And if I want to get my account back up to here, or I want to grow my account as quickly as possible, at a certain point, there's a question of how do I either take bigger share size on the 3 to 5 trades I take each day, and or how do I increase the quantity of trades I take just to have more trades so I'm growing my account faster. So I think the rule of thumb that I use is that to scale up this strategy, you trade 1 trade a day until your account is above $25,000. So when you're at $23,000, $24,000, that 1 trade could be buying 4,000 or 5,000 shares of a $5 stock, right? You're using all your buying power, 1 entry, 1 exit. The goal is 20 cents per share of profit, sort of at a minimum, using 10 cents per share of risk. So you're locking up $1,000 on winners. That's fantastic. $1,000 a day consistently, that's 6 figures a year. You can't complain about that. And so once you get the $25,000 account, what you know is you'll get margin and leverage. So now all of a sudden you've got $100,000 of buying power. So you could, in theory, see a $5 stock and take 10,000 shares. So the first step, in my opinion, is not to increase the quantity of trades, but to increase the position sizes on A quality setups. Because it's the A quality setups, they're going to put the biggest dent in your profits. So we start number 1 by going up to 3 to 5 trades a day, but with larger positions, larger position sizes. And then there's the question of, okay, well, what's my accuracy on B quality setups? On A quality right now, maybe I'm averaging 85 to 90%, right? Approximately. This is the percentage of success. On B quality setups, honestly, that's probably where I'm going to be around 70%. And when I start taking C quality setups, that could be, 50 to 60%. So there's a certain point where, let's just say, A quality setups in terms of profit, where if you're trading only A quality, you're gonna have really nice profits. If you start doing B quality, you're gonna see a little bit of a decline. You start trading C quality, you're gonna see your profits go down. So at what point do you kind of maximize getting the most growth and increasing the quantity of trades without having this rollover? In fact, if you were growing your account at that rate with A quality setups, if you're growing your account with A quality setups here and you introduced B quality setups, but you maintain good accuracy, your account would grow even faster because now this is A plus B. But then A plus B plus C, maybe that's where you start to come back down, right? Now you start to come back down because the C quality setups are drawing you down. You add D quality setups, and now this is where you're actually stair-stepping down. So there's a line somewhere in here where reducing your quality standard to introduce more trades is going to no longer be profitable. And I think as a beginner trader, the good news is you have a lot of opportunity to grow and to be very successful saying I'm only trading A and B quality setups. Now, how you define a B quality setup, is obviously going to be subject to your own sort of standards. For me, I would say anything that I look at and I'm like, this is not A quality because there's something about the stock that's not perfect. Maybe there's no news. Maybe the relative volume is a little lower. Maybe the float is a little higher, right? Or the setup. It's a good stock, but the setup is a little funky. It's kind of already done a false breakout. It's a little riskier. It's a B quality setup. Anything that's not A, but is close to A is a B quality setup. And so on each day, you might get 3 to 5 A quality setups, and you might get, 15 to 25 B quality setups. So if you're willing to reduce your accuracy, and as long as you can manage your risk, you can increase your quantity of trades definitely significantly by reducing your quality standard. But just expect accuracy will go down and your profit loss ratio will also go down because as you introduce more losers, you'll inevitably have some that get a little bit big. And so what most traders end up doing is, and we can look at my metrics here for the small account challenge right now. So currently averaging 90% success, 90% win rate, $622 average winner, $154 average loser. So 4-to-1 profit loss ratio, 90% accuracy. That's a great win rate. I don't think I'm going to be able to maintain that forever. And I don't think I would choose to because I want to introduce higher quantity of trades in order to grow the account a little bit faster. But what most traders do is and the right way to do it is to start trading with a lot of filters on your account. So you're being super restricted. You're only trading the setups that you know are going to work. And I keep holding this book. This isn't about day trading. It's about playing poker, but it carries over really well. So you're trading only the setups that you've got the highest degree of conviction in. And then you start to sort of take off the training wheels. You start to expand a little bit. And in a hot market, C quality setups might work just fine. But in a cold market, you're going to get crushed. So you sort of learn to sort of take the training wheels off, take the guardrails off, take the filters off. You start to expand, and then you'll have a loss. And what do? You got to bring it right back in. Really quick. Ease off the throttle. Go right back to core basics. Start to rebuild consistency, rebuild success, rebuild confidence, and then scale back out. And then you'll have another loss, and you scale back in. And then you scale back out, and then you scale back in. And there's nothing wrong with that. That's the right thing to do because you got to trade at the edge of your comfort zone if you want to be growing your account. But when you're starting day one of a small account challenge, you've got to be focusing on one trade a day, A quality setups. And the right way to start to manage your risk truly is to practice everything I'm sharing with you right now in a simulator. Prove you can meet the metrics of success in a simulator before ever funding a real money account. That is the right way to get started. Now, if you haven't already downloaded the collection of PDFs, there's a link in the top of the comments and in the description. I want to make sure you guys download them, print them out, use them as a resource, and start implementing these techniques in your own trading today. And I want to remind you, as always, my results are not typical. Trading is risky. So take it slow and protect yourself by practicing in a simulator. If you enjoyed this episode, I hope you hit that thumbs up. I hope you're subscribed to the channel for more episodes about trading strategy just like this. And I'll see you for the next upload real soon.